the debts, first of all, this is not a lot of space for debts. Many people have a lot of debts.
Yeah.
The biggest problem with the debt section, if you look over here, there's like a list, right? It says show your mortgages, charges, liens, notes, credit cards, accounts payable.
Yeah.
Don't forget money owed to CRA, and then contingent liabilities. Okay. And I want to talk about contingent liabilities for 1 minute, and then I want to talk about debts to your family for another minute. So contingent liabilities refers to the fact that certain assets require money to get rid of them. Okay, let me give you a very easy example. Let's say you have a checking account and you have $1 in it, right? And let's say you have an RRSP account and you have $1 in that also. I think, Heather, you would agree that they are not worth the same dollar, because to take the $1 out of your RRSP, you have to incur tax.
Right.
Right?
Right.
So now how do we compare an RRSP to a checking account? We can't. We have to acknowledge that there's some tax liability.
Right.
Okay. And so then the question is, but you're not taking out the RRSP today. You're going to be taking it out later when you retire, likely.
Right. Right.
So then you have to ask yourself, question number 1 is, are you, for any asset, are you going to be disposing it in the foreseeable future? Okay. And if yes, what future discounted rates do we apply to it? Okay. Now this issue, nobody knows about this, even though it's right there black and white in the debts. But if you have an RSP with $100,000, that, the disposition rate, depending on your tax rate and other factors, can be as much as, and I'm throwing out a number in the air, let's say 30 to 35%. Okay, and that's really high from what our going rate is of somewhere between 20 and 25%. But that's $30,000, right? Of value that you don't have to share because you don't really have it.
Right.
Wow. Same thing for property. So when you sell a property, there's going to have to be real estate fees, right? The one that people don't think about, and you certainly should think about this if you have cryptocurrency, is that for investments and investment properties, there will be capital gains tax. Right, to dispose of a property. So these things are not necessarily simple to quantify. But there should at least be a line item for it. Okay, so as simple as saying contingent liability.
I understand that. Oh my goodness.
RRSP number 757, right? And it's $100,000, just making that up, right? And then even if you don't want to put a number, but you just know that this is an issue, you can put TBD. Okay. And really, this is an issue not so much for the today column as much as it is for the date of marriage and date and valuation date. Okay. And really, the contingent liability is, you can specify, you can just say tax. Fine. Okay. We're going speeding through this. The debts and liabilities of marriage, really, this box here is tallying all the date of marriage. Running through the entire document. Okay, it's just a tally. Okay, quirk number 2 of the, right? So quirk number 1 was that matrimonial home.
Yes.
So if you have that matrimonial home on date of marriage, you do not include the mortgage here. Okay, you're right. Like that's specifically for the matrimonial home. For date of marriage. Okay. Quirk number 2 is excluded property. And the simplest way to explain this is as follows. There is a list in the Family Law Act that says that certain property is not, it can be excluded. Let me say that clearly. Certain property can be excluded from the calculation that you don't have to share, basically. And so the first thing is you want to know is, I like to say start at the end. Look at all of your assets above and say to yourself, do any of these assets include something that is excluded? Okay, now the form used to have the list. So let's say it's an inheritance. Okay, from Auntie Aunt Jane. Okay. Now the question is, you have to always start at the end, which is, in which asset is that inheritance? Because if you went to Tahiti and spent it, we don't care. We only care of the value on valuation date. So let's give a simple example. You inherit $5,000 and you put it into your TFSA. So you would put TFSA, right? And now you can be as detailed as you want. You could say received in 2018. Yeah. Currently in TFSA 7890. Okay. And the number that's here has to be as much or less than what's in the TFSA, because it has to exist on date of on valuation date. And there is the problem of mixing money and using some of the money and mixing the money. You can also, it might also be, you know, you bought a car, right? And refer back to the car that's up there, that Mazda, right? Now the Mazda is a depreciating asset. So you might have put in $10,000 purchase, but you're only going to put the value at separation. So I'm going to use, let's say 3,000 for the TFSA, right? But the Mazda, I think we had said was 8,000. I don't know, something like that, right? Because it depreciated. It's the value on the valuation date. You may be asked to do something called tracing. And tracing means starting from the valuation date and working backwards, or more importantly, starting from the date of receipt and working forwards. Okay, you need to show that it's the same money. It's the same inheritance money. Again, there is case law for every which way where people mix up the funds. They put it into joint names, they put it into special assets, and then do crazy things with it. So I just the takeaway for excluded property is it has to exist on valuation date. You can't just say, oh, I received an inheritance. It doesn't work that way. You have to, it has to exist and then linked back to the receipt. That might require getting bank statements that go back years and years and years. So it could get complicated. It could also include some spreadsheet analysis when you mix stuff up. Okay, the last paragraph, the last box here is just disposed of property. And the truth of the matter is most people, if they sell anything in the last 2 years, you know, this has no impact on the calculation. It is more of a, if you want to call it a trust building exercise as to whether or not money was moved in contemplation of separation. Okay, and the truth of the matter is the word disposed of is you know, doesn't say much to you and me kind of thing. It's not a very good word, because what if you took $200,000 and you transferred it to your parents? Right, like that is disposed of also. And I don't think people would think to put it in here, right? That you would only think dispose of means to sell. Right. So the short answer is use this as a trust building. If you moved money, be open about it and then explain why. Because if you explain why, then that's all good, rather than it being discovered.
Oh, that's so interesting. I was going to ask you that question because okay, so realistically, I think a lot of people, maybe they are interested in filling out the watching our video today, not so much the how to fill it out properly, but more like how to fill it out so that they can minimize their NFP. So one of the things they could do is they might start gifting property to their children, to their parents, and then they will say, you know what, you were going to have that painting anyway. You were going to have the sideboard anyway. Well, mommy is going to get divorced. I don't really want all this property in my NFP statement or my financial disclosure. So here, you take this and you take this so that I don't have to list it all in my form. I think people must do that, don't they? Because they don't want to include every single thing that they own, so they give it away. But then now you're telling me, even if they did that, they really should be putting in like, oh, the painting went to my daughter, or the piano went to my parents. Like, so you should actually be putting that down, right, in your financial disclosure.
Most people don't.
They don't.
I mean, if they're doing it with that intention, they certainly won't be doing that. Okay, I mean, there's a short answer and there's a long answer, but first, for brevity, let's just do the short answer, which is, who are you fooling?
Right.
Who are you fooling? You're fooling the person that you are living with.
That's right. Yes.
So
that's right.
Once they start pulling that string and saying, what about this?
Yeah, what happened to that? Yeah.
What happened to that? What will happen is that it's going to trigger requests for historic documentation. Right. And it's not a fun exercise, but usually the person who is hiding information and then it gets discovered usually bears the consequence for the discovery. Okay, so I'm saying that very broadly.
Yeah.
But I like to assume that most people, recognize that relationships come and relationships unfortunately go.
Right.
And the point of the filling out the form, once you understand that it's to get to an end result, and there are legitimate ways to reduce your net family property, right? The contingent liabilities is one good example. That it doesn't require even the assumption of nefariousness, right? But to know that the law has mechanisms to deal with nefariousness if it comes to the last glitch, just that you should know, and it's not so much a glitch as it's a feature, not a bug, to some extent, is right over here with the calculation. So let's say the value of all your property that you owned was 100,000. I want to make it easy, so let's call it $100. Okay.
Okay. Yeah.
And then you have all the debts from date of data separation, minus this one box is doing a lot of heavy lifting. All the debts from data separation, less your net worth as of date of marriage. And so let's say that equals 30. Okay, all of that together. And so now your balance is 70. And of the 100, 10 of it was from Aunt Jane, right? Is that the person's name?
Yeah, that's right, Aunt Jane.
Okay, and so now the balance is 60. Okay.
Yeah.
I think what they do, yeah, whatever. Okay, so your net family property is 60.
Right.
Okay, now what if your debts were 130?
Yeah.
Okay.
Yeah.
So if your debts were 130, then you're now in negative 30.
Yeah.
Okay.
Yeah.
And you still have that balance that of the 100, only 10 of it is not included, so, or is excluded, let's say. So now you're at negative 40. You would say to me, why do we have an extra box here? Because we already have the balance, it's negative 40. And the answer is that the glitch is that there's no such thing as a negative net family property. Your form should never be less, your net family property should never be less than 0.
Okay.
Okay. And the reason for that is we're only sharing growth.
Okay.
So I have had the situation where 2 clients, unfortunately, are both substantially in debt.
Right.
And there's no equalization. They are just sharing debts. They're sharing debt based on title. In other words, they had a joint credit card, so 50% each on the credit card, right? But there's no equalization calculation because there's no net family property to equalize.
That's interesting.
Okay, that's okay. And let me just conclude now that we've filled out the form, that as you're going through this, and really you can do this at the stage after you do your apricot list, right? So you list all your bank accounts, and then you need to start gathering, at the very least, bank statements for valuation date and bank statements for marriage date. Okay, it's good form to do the today date also, but today always changes, right? So it's sometimes it's not healthy to try to chase the today.
Right.
But you have to get your documents for valuation date, and let's just link it back to our very first video and go to your financial disclosure. And we had done a very simple box, like online storage. And so for your assets, you can start dumping all the bank accounts here. Okay. If you want it to be very adventurous, this is what I do with my clients. I take all of the list of all of the headings in the financial statement, and I make, even if you don't have anything under business interest, you at least have the box there to collect the documents, okay? I break up the date of marriage into two: date of assets and debts and liabilities. And there's a box here for exclusions also. And so what you should be doing is collecting the bank statements, saving them either as PDF or screenshots, and then dumping them into your savings right over here. And then you'll be able to share that when you provide the financial statement.